For the last few years, the market has been telling us a story. A story about infinite growth, all powered by fancy algorithms and limitless data. But here's the thing. Underneath that entire story, the laws of physics have just been waiting. And in 2026, the bill is coming due.
What if the single biggest, most crowded trade of the decade is built on a physical foundation that's about to shatter? Because if you look at the math, that is exactly where we're headed.
To really get what's happening, you have to look at how the market is pricing the future. And it starts with this number, 35x. That's the forward price-to-earnings ratio for the tech sector. It means investors are paying $35 today for every $1 of earnings they hope companies like the Magnificent Seven will make next year. It's a bet on absolutely explosive, unstoppable growth.
Look, a valuation like that, it doesn't just assume growth. It assumes a world with no physical limits, a world where infinite compute power can just be conjured out of thin air, with zero consequences for the power grid, for resources, for reality itself. It's a beautiful story, right? But that's all it is, a story.
Okay, now let's flip the coin. Let's look at the physical world, the energy sector. The companies that literally keep the lights on and the data centers running is trading at a forward PE of just 8x. The market is telling us it expects almost no growth from the very foundation of our entire digital world.
The market is pricing these essential assets as if they're going out of business. It doesn't see them as the engine of the digital economy, but as some kind of dirty, dying relic from the past, a liability.
So what we have here isn't just a valuation gap. It is a fundamental, mathematical break from reality. You simply cannot have one sector priced for a limitless digital future, while the sector that provides its electricity is priced for oblivion. These two parallel universes are on a collision course.
And that collision is creating one of the biggest structural rotations in modern market history. And this channel, well, it exists to track these exact kinds of shifts way before they become obvious to everyone else. So the real question is, who are the hidden gatekeepers? Who actually holds all the pricing power when digital dreams slam into physical limits? Let's find out.
All right, so the core of this entire thesis is actually dead simple. The exponential demand from the digital world is about to hit the hard linear wall of physical supply, and you cannot software engineer your way around the laws of thermodynamics.
See, so far, Wall Street has only been focused on the power needed for training AI models. Those massive, one-off compute jobs. But that's not the real story. The true energy tsunami is inference. It's the constant, 24/7 demand from billions of us querying these models, all day, all night. That demand never, ever sleeps.
And this isn't some analyst's wild guess buried in a spreadsheet. This demand is real, and it's already showing up in the utility interconnection queues. These are the formal requests for grid hookups. We're talking about hyperscalers planning data center campuses that each need a full gigawatt of power. That's the same amount of electricity it takes to power a major city for one campus.
Now the pushback you'll always hear is, oh, but the chips are getting more efficient. And yeah, they are. But that is a classic, textbook misunderstanding of Jevons paradox. See, making AI inference cheaper doesn't decrease total energy use. It just makes it possible to embed AI into everything. Our cars, our refrigerators, our factories. It drives total consumption up exponentially. Efficiency doesn't save us, it buries us in more demand.
And this, right here, is the heart of the problem. Tech is valued on the speed of software, but it runs on the speed of infrastructure. You can build a shiny new data center in 18 months. Great, but that giant transformer you need to plug it in? That's a 3 to 4 year wait. And the new transmission lines to get the power there in the first place? Good luck. That's a decade-long regulatory nightmare. The physical supply chain isn't just slow, it's broken. And hey, don't just take my word for it. The industry itself is now openly admitting it. Intermittent power like wind and solar, it just can't provide the 99.999% uptime that AI absolutely requires. So data center developers are turning back to the only fuel source that can deliver reliable power on demand, natural gas. So you might be asking, how does a physical problem, a bunch of waiting lists for transformers, turn into a massive market repricing? Well, it happens through the one thing big tech can't code its way around, bureaucracy. In their attempt to protect the grid, regulators have accidentally created a fortress and handed all the pricing power to the existing energy companies. So I want to introduce you to a new character in this story. They're probably the most powerful player you've never heard of, FERC, the Federal Energy Regulatory Commission. In late 2025, they quietly made a few rulings that basically ended big tech's long era of getting a free ride on the nation's power grid. This right here, this was the watershed moment.
The hyperscalers thought they had found a cheat code. It's called co-location, where you just plug a data center directly into a power plant and bypass the grid entirely. Well, FERC killed that idea. They ruled that tech giants can't just siphon off clean, reliable power and leave the public to pay to keep the grid stable. And here's the kicker. Amazon's demand was so inelastic, so desperate, they bought the power anyway, but front of the meter, paying all the grid fees. They just set a new, incredibly high price floor for reliable power.
So, right after that ruling, FERC turned to PJM, the biggest grid operator in the country, and basically told them to rewrite the rulebook. Now there's a new pay-to-play system. All those critical services that keep the lights on, frequency regulation, standby capacity, big tech has to pay for all of it now. This closes every single loophole and funnels a river of cash and power directly to the owners of the power plants like Constellation and Vistra.
If this is the kind of breakdown you don't usually see, that's intentional. Subscribing just means you won't miss the next one. Okay, so for any big rotation to happen, money has to flow from somewhere to somewhere else. So who's paying the bill for this massive energy build-out? Well, the money is coming directly out of the margins of the hyperscalers themselves. And Oracle is the canary in the coal mine. See, unlike its cash-rich peers, Oracle is funding its entire AI dream on a mountain of debt. Their capital spending is projected to blow way past their operating cash flow, and the bond market is getting nervous. The cost to insure their debt, their credit default swaps, has widened significantly. That's the bond market, the so-called smart money, signaling serious distress. Then you've got Meta. Their projected Capex for 2026 could top $100 billion. And a lot of this is just defensive spending to keep up, with a really murky return on investment. And you remember what happened back in 2022, right? The market absolutely crushed Meta for this exact same behavior. Well, history looks like it's about to repeat itself. And if you think, well, that's just Oracle or Meta, think again. Even the king, Microsoft, is hitting the wall. They flat out admitted on their late 2025 earnings call that they are supply constrained because they physically can't get enough power. Now, for a stock that's trading at over 30 times earnings, any hint of a growth slowdown.
Now, the best part about all this, it isn't some wild theory about the future. It's already happening right now, in real time. You just have to know where in the market's plumbing to look. The smart money is already on the move. Just look at this divergence. It is stunning. On one side, you have hedge funds and institutions. They're quietly selling their Magnificent Seven stocks and rotating that cash into energy and industrials, taking their exposure to multi-year highs. And at the exact same time, retail investors are piling into AI-themed ETFs at a record pace. If you were to write a textbook on classic contrarian signals, this would be chapter 1.
So this brings us all the way back to the beginning, back to that question we started with. Who are the hidden gatekeepers? Who really has the pricing power? It's not the coders. It's not the algorithm designers. In this new world, the real power, it belongs to the people who own the physical iron. The real winners here are the ones who own the toll roads. These midstream companies, they own the pipelines that have suddenly become the most strategic assets in the entire country. We're talking about Kinder Morgan, Williams, Energy Transfer, Enbridge. They control the irreplaceable arteries that will deliver the natural gas to fuel the entire AI boom. Their assets literally cannot be replicated. But here's where the story takes a really fascinating turn. We're starting to see a whole new business model emerge called digital upstream. Natural gas producers are figuring out they can make way more money by not selling their gas. Instead, they're building data centers right there at the wellhead, and they're selling compute power directly. They're capturing this massive arbitrage and basically becoming their own vertically integrated tech companies. And believe me, this doesn't stop with power. There are two other massive squeezes coming right behind it. First is sovereign AI. Countries are demanding that data be processed locally, which is going to force a ton of redundant, energy-hungry infrastructure to be built, driving up global demand for LNG. And second, the next bottleneck after power is water. Data centers are incredibly thirsty. You can expect to see a huge migration of data centers away from water-stressed places like Arizona and back to the Great Lakes region. The entire investment landscape is being redrawn, not by lines of code, but by the laws of physics. The next big phase of the AI trade isn't about owning the model, it's about owning the molecule and the electron. Most people just watch the markets. This channel explains why they move. Subscribe if you want to stay ahead of that curve.